Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for ChartsandMarkets.com. Welcome back to the show, Bob.
Well, yes, Jim, on this gloomy Friday morning, gloom when I look out the window at the weather, and also there's kind of gloom around in the financial markets.
Bob, as usual, we start off with a listener question. This is from Justin, who's a subscriber to Charts and Markets. He says, I know Bob is very popular these days, so maybe I can fit a question in. With the stock market crash, there's been a liquidity issue that forced the Federal Reserve to expand its criteria for repo QE monetization. Many people are regarding this as a hyperinflationary event, but it seems as if, as Bob alludes to all the time, the dollar is chronically strong for long periods in a bust. Does the crash in asset values just vaporize leverage and money out of the system? Is that why the U.S. dollar is so tough?
Yeah, Justin, you can write we'll invite you to be one of our writers. Because that one, does the crash in asset values just vaporize leverage and money out of the system? Yeah, that's what it is about. And the idea that the Fed can inflate prices is not borne out by history, because it's the public that decides what's going to be inflated. And like all the gold guys learned in the 1970s, that the Fed was evil, it's going to depreciate the dollar forever, and gold was going to go up forever. But unless you were a copper person, and of course then copper was going to go up forever. But the pattern has been, you get a decade of inflationary boom in tangible assets. Commodities, houses, wages, all that sort of stuff. And then it reaches a climax, like in 1920. And then there's a crash on that stuff. Everybody gets burned out. And then out of that wreckage, you start with a speculation in financial assets, stocks and bonds. So I looked at it in 1980, the transition, and when you had a big commodity boom to 1980, and by 1982 it had shifted over to financial assets. And I remember looking at it at the time, and if you looked at money supply, M2, there was no setback. The growth continued. You had a global boom in commodities, they crashed, and then out of it, people shifted over. So the public decided that it was going to speculate in financial assets, stocks and bonds, of which the commodities get a lesser play. I mean, they'll go up in a great financial bubble, and then it burns out, and then you get a crash. So here is the pattern: long economic expansion, mania in commodities, crash, then a long bull market that develops in stocks and bonds that ends up as a mania, which we had into December, January. Then crash, which, yeah, in hindsight, we can now call this a crash. And then comes the puzzlement. It goes into a long contraction where all asset classes are marked down. So you have inflation in financial assets right through until January, and now you have deflation in financial assets, and also they've marked down prices of industrial commodities as well. So I see nothing unusual out there. Dramatic, yes, but not unusual And Jason, thanks for the question. Justin, thanks for the question.
A question from James. We seem to see the markets now go up during midweek and then take another dive on Fridays. Is this a pattern we're going to see from now on or for the foreseeable short-term future?
Yeah, I think it's to do with the volatility, because traders are just not going to be long or short going into a weekend, because, out there anything can happen. Any government anywhere can do something weird. So it's best just to flatten your position. So it seems to be maybe marking things down on a Friday, but hey, it's a wild market out there. Very difficult times for fund managers. But actually, if you're a very nimble trader, and I'm not a short-term trader, but for nimble traders, it's been, and if you're good, it's been good. So, remarkable volatility.
We'll have more with Bob Hoye right after the break.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Welcome back. We're speaking with Bob Hoye. Bob, a credit rating agency has downgraded some bonds 9 notches, going from AAA to BBB, which is just one notch above junk. Where did that happen? Why did it happen? And what does it mean?
Well, yeah, this was commercial mortgage-backed securities, where they take a bunch of mortgages like on shopping centers and malls and stuff like that, and bundle them, and then they're supposed to have a wonderful rating, although the stuff underneath it may be junk. But in 2000, the way it works in a lower grade bond market is that in a boom, people are confident, bid them up, and then when you get into the contraction, all of a sudden you begin to realize, hey, can people service this debt? So then they get marked down. And the credit rating agencies, they're methodical. They have to do a proper job of keeping the company's financials under monitor. But at any rate, in the 2008 crash, there would be suddenly an announcement where a certain issue was downgraded by 3 notches, and that was at the time shocking. So here's this one. In an instant, from AAA to BBB, a 9-notch drop. That's why I made a note of it. But also, decades ago, I knew some guys at they used to call it Dominion Bond Rating Agency here in Canada, and I remember talking to them about the problem of when you're downgrading an issue to just above junk. Is that if it's downgraded to junk, then all those funds that are not allowed to own junk have to sell it because they've positioned it. So it's a horrendous step for a credit rating agency to drop a rating to below investment grade, because it's has severe implications. So they really are reluctant to do it. So it's just the way the market works. So here we are with a 9-notch drop. It is amazing. But then we have been in an amazing liquidity crisis anyways. But when you look at it, it's, the markdown in prices. I looked a while ago at what happened in the fall of 1929. RCA, the big stock then, Radio Corp of America fell from 114 to 28 in 2 months. And then in the bubble of 1873, when it finally crashed, the big tech stock, high-tech stock was Western Union Telegraph, and it gave up about 40% in about 5 trading days. But generally, these very heavy markets can last about 2 months. So that counts out to somewhere late March, like around now. So one can look for some stability to build. It needs to do it before it can muster a rally. But there was one of the wisest lines I can recall reading was in the Economist magazine with the 1873 bust. And in an editorial, they said that while the panic may be over, the results of the panic are not over. And we then go back to history where every severe financial hit has been typically followed by a credit contraction and an economic recession. So this is what seems probable now, sadly, but let's face the facts.
We'll have more with Bob Hoye right after this.
Cypress Development Corp is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, the Bank of Canada plans to inject $5 billion in Treasury purchases a week as part of its economic recovery plan. Plus, the Bank of Canada has again made an emergency cut to interest rates to 0.25%. Will these measures make any difference?
No, quite frankly. And one issue, of course, is the drop in short rates. And at a boom, and it gets a little nervous, and then the Wall Street pundits will come out and say, oh, all's okay because the Fed will cut rates, and that will keep the boom going. But that's dreamland stuff, because if you just straight look at the history of interest rates, you got two kinds of interest rates, short-dated, 3-month T-bills, and then what they call the Fed funds rate, or here in Canada, the Bank of Canada, it's an administered rate. And the Treasury bill market is trading all of the time. So what happens is that in a boom, the T-bill rate goes up, and then when it turns down, it signals that the boom could be ending. And the T-bill rate went up until, what was it, last year, June? And then it turned down. And we now see why the interest rate turned down, because the boom was ending. And while there's a lot of noise about the corona disease, it's sort of a catalyst. But let's just go back in history. In 1929, the New York Fed was, of course, the biggest and powerful of all the Fed branches. And it stepped into the crash and bought bonds out of the market. And one number I saw is that the Harrison, who was then head of the New York Fed, had exceeded his lending authority by a factor of 6 times. So the Fed tried. And then if you move ahead to July 1932, when Barron's, the esteemed financial publication, in an editorial, they pointed out that every So the Fed had been buying bonds out of the market, and they point out that every anti-deflationary measure taken by the Fed is not working. But that was ironical because that was July 1932, which was the bottom of that horror show, and then you had a rebound. But I would take Barron's statement on that as sound, that the Fed did try to reflate. Interest rates, the T-bill rate fell to 0.08%, and so here we have the same thing now. And then there's an additional irony. Not only do short rates go down in a bear market, but they plunge the fastest in the worst part of the bear market, such as we've seen with this massive hit to the financial markets. So the theory that a central bank can cut rates and make things better is hopeless. It doesn't relate to reality at all. And of course, you've got to go back to the people originally promoting the Federal Reserve System. And it was, of course, formed in 1913. But they knew that a financial setback, a hard hit to the financial markets, would be followed by a recession. It's the way business cycle works. So their theory was that with the Fed as a lender of last resort, they would be there to make sure that financial crises didn't occur. So that's the theory. And there's been 18 recessions since 1913, and it's very clear that the theory does not work, and yet here we have then the Federal Reserve making dramatic cuts in short rates in their administered rate, following market rates down, and now we, of course, got the Bank of Canada making their noises as well. And it's kind of thing you can say about it, it's bureaucratic ritual, that they have this job and they're supposed to do it, and it won't make any difference at all. I think a serious contraction has started. It certainly has had all the symptoms, and there's nothing anybody can do about it.
Bob, thank you so much for chatting with us.
Well, it's been a very cheery conversation, hasn't it, Jim?
You and
maybe we can have some cheer next week.
Always. There's always cheerful stuff somewhere, Bob, even though we can't mention it on air sometimes. My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. If you have any questions for Bob or any of our other guests, you can send them to info@howestreet.com. Find us on Twitter @HowStreet. Our YouTube channel is Talk Digital Network. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.